Welcome to AssetTV's Fund Fit Summit with me, Joanne Baynham. Today I have the pleasure of chatting to Stephán Engelbrecht, Mazi NextGen, Portfolio Manager. Welcome. Okay, so who is Mazi NextGen? It's not a name I'm terribly familiar with.
Yeah, I don't blame you. We're quite new on the scene. So Mazi NextGen is a joint venture between Mazi Asset Management and then the employees of Mazi NextGen. It's myself, my two colleagues, Alvaro Kaza and Gaines Barner. And we came up with the idea of potentially how the next generation of funds are going to be managed in South Africa. We pitched it to Mazi. They said, this sounds very interesting. And that is how we went into a joint venture in 2022. And we launched our first funds in 2023.
Okay, so we're now in 2026, you're 3 years in. Where were you before? So, I assume you've been in the markets for a long time, that you were thinking of pitching a new idea for markets. You didn't come straight out of varsity and say, I'm going to have this new idea for markets. Tell us a bit more about your history.
Yeah, no, unfortunately, I couldn't do the Adrian Core thing of coming out of varsity and starting a multi-million brand business. So I launched my career in 2005 as I came out of varsity. I was a fundamental analyst, predominantly in the hedge fund space. And then I joined Capricorn Fund Managers, who was one of the leading fund managers, one of the oldest hedge fund managers at the time. And through them, I learned quite a lot about fundamental investing. Over time, I also became a portfolio manager with them, managing all the South African hedge funds. We had a very fundamental focus, so perhaps a little bit more momentum driven. So we were very cognizant of momentum, but valuation, business models, all of those normal analysis that we would make, or that you hear from a lot of asset managers from. And then we were very successful, actually. We won quite a few awards at the hedge fund, Hedge News Africa award ceremonies for many mandates for our long-short equity as well as for our market neutral of the funds that I managed. Then in 2016, there was a corporate action. Anchor Capital brought out Capricorn Fund Managers. And then always with corporate actions, there are a little bit of ruptures. So I started to become a little bit more open to what's happening in the market. And I was always been very interested in more quantitative. So I always liked the Cliff Asness, Jim Simmons type of investing. For three main reasons. And I was reflecting on myself. So even when our funds were doing very well, I could never quite say that I was really, really good at managing money or whether I was just extremely lucky, and there was no way of really analyzing that. Secondly, I always struggled to really put probabilities in my conviction list. So perhaps I would like Capitec and Mr. Price, but I couldn't say that I had a 65% probability for Capitec and a 58% probability for Mr. Price. Those small little probabilities was always just a little bit too difficult for my mind to manage. And then finally I never knew whether I would make exactly the same decisions with exactly the same information from one day to the next, because as human beings, we can be primed quite often. You may be in a good mood, which means you would rather buy than sell. You may have read a book about fundamental or valuation, or a book about momentum, and that will lead you to focus more on the momentum or on the valuation side, depending on how you were primed. And that always bothered me. And then here into 2017, you started hearing more and more about the rise of machine learning. And machine learning has always been there. Well, not always, but from about the 1950s, it was always there. But the biggest problem, the maths was there. But the biggest problem was computational power and data. And here in 2017, you had a massive increase in the computational power of machines. You've got cloud computing more and more coming to the fore. And I started dabbling in that. And then in COVID time, I really had a lot of time to spend. We all had to spend on other ventures potentially. And then I really took a deep dive into machine learning, and I just realized that this will solve most of my issues that I had with fundamental investing, and that is how I developed the strategies for Mazi NextGen.
Okay, so you realized that there was something missing with fundamental analysis, possibly human behavior from the sounds of things, that machine learning could improve upon. And this is what you pitched to Mazi, is that correct?
That's correct, yes.
Okay, so tell us more, like in more granular detail, what you actually now do on the quant side, quantamentals, machine learning. What are the kind of buzzwords that you're using now in terms of how you guys run money?
Well, I try to avoid the buzzwords.
Okay, no, that's fine.
But let's
the ones
yes.
that work for you and the ones that you're using, because I think the problem at the moment in the industry, there's so many words thrown around. A lot of us don't really understand what they mean. So what do you mean when you talk about using the machine, using data? What data? Why is the computational power important? Just give us a better feel for what you're doing that's different.
Yeah, so I think firstly, let me also make it quite clear. It's not as though we use Claude or Gemini or ChatGPT to do analysis for us.
Mm-hmm.
They do make us more productive because they really help us with coding. But we developed our own in-house algorithm to basically encode the experiences, our own lived experiences, but also there is so much academic literature out there that you can start to encode into these algorithms that can then try and find the combinations of features that can lead to outperformance over time. So to answer your question, what do we actually use? So we use machine learning algorithms. There are many of them. We won't go into too much detail, but basically it's just a way, different ways of asking the machine to learn from base features. And this is like valuation, so PE ratios, price to book ratios, momentum analysis, technical analysis, and all the normal stuff that a lot of people talk about. You feed that into the machine, and you tell the machine, if a share had these features on a date, can you identify which one of those led to that share outperforming over time? And then you give it as much information as possible. Machines always like more data is better. That's why as we got more and more information, it became more powerful to do. And then the machine will start iterating through the process and give you a probability of saying that given the current characteristics of Mr. Price or of Capitec, it believes there is a 60% chance, a 62% chance of Capitec outperforming over the holding period that you design.
Okay, so you talked about lots of things there. So first of all, data. Where are you sourcing your data from? Because data seems to be the new frontier for a lot of people today. The new gold rush is all around data. And you made the comment that more data is better, but there's a lot of arguments to say today that more data is making these machines hallucinate, and it's actually becoming worse. So maybe just give us a better feel for what you mean by data.
Sure. So there are definitely two types of data that we focus on. So the first one is the fundamental data, the data from sales, the results that company reported. We have to give kudos to the JSE. They were really good at starting to capture data very early on. I think we are, other than the US market, we are probably some of the market that has the longest history of fundamental data that is digitized. So we have all of that information going back into the 1990s, about 1995. And then, so that forms the basis of the machine. So the inputs that we give it. Then, as you say, there's more and more gold rushers trying to extract data that is only our data, that we know nobody else can use that.
Proprietary data.
Proprietary data.
Yes.
And this is from, and now we're becoming a little bit creative. So for example, we've built our own large language model where we get a lot of sell-side research on a daily basis. We import that into our large language model, vectorizing the data. And then from that, we can build a sentiment indicator. So a specific sell-side sentiment indicator. So we're not using Twitter. We're not using Reddit or all of the noisy data. We actually use real sell-side information how they have felt about a stock and try to see whether that sentiment led to out or underperformance over the holding period. So that's, for example, one that we've built in. The other one is using straight data. We're actually we can track the holdings of the large asset managers in South Africa on T+3, not like quarterly or monthly. On T+3, we can pull the data and we can see what the largest fund managers actually have in their portfolios, and then we track how that changes. So if we see many South African fund managers are starting to buy a share, then we will import that into the model and see whether the model can use that information to also identify future outperformance. So those are types of specific, our own proprietary information, but we are very weary of only using well-sourced or not just sentiment that's from Twitter and stuff like that, or X these days.
Okay, so let's go back to one thing. You talk a lot about the machine and the algorithms and the data you're using. Where are the human beings involved in this? Because you mentioned in your opening comments you like Jim Simons and the way he ran money. No, we all do, and we wouldn't be sitting here if we were. But he was quite adamant that the machines kind of made the decisions and human beings kind of looked in ever so often. Is that your same philosophy? Like the machine's right, and we've got to be absolutely certain if we're going to override the machine? How do you think about that?
Yes, we definitely follow that philosophy. So where is the you? I mean, but it definitely doesn't mean there's no you.
So it's not just a black box. You guys are still involved in looking at the decisions.
Yes, absolutely. But the humans play such an important role in creating the machine. So it's not as though this is a machine that is just creating itself almost to some extent. Where we come in is we do the research. So we go and all the features that we put into the machine has to make economic sense. We're not just going to put in, I don't know, hair color of the CEO or something like that is a bizarre, that doesn't really make sense. Because machines can go and find reasons to go buy something that can be completely hallucination or complete hallucination. So all of the features that we provide the machine from which to learn must be grounded in economic theory from our own experiences or from academia. And then we also have to test which algorithms are best. We have to read up on which algorithms in the past have done the best in the given certain environments.
So I'm going to stop you there. So you said certain environments, okay? Does the machine also decide which environment you're in, or the human beings decide the environment? So I'm going to give you a classic example of that. Some people are not arguing that we could be in a sort of stagflation environment globally. Is that your human input, or are you saying to the machine, what kind of environment do you think we're in? And then the machine says, we think we're in this environment. Now, based on this environment, these are the rules that work. Just in terms of that word of environment?
Yes, so exactly the second. So we input macroeconomic information into the machine.
Okay.
So that's also the great thing with machines is that they can consider far more variables than just GDP and inflation. It can actually, we've got 27 macro variables that we import into the machine, and the machine can then identify which market regime we're currently in.
So what are we currently in?
So it's still very much in a high commodity, high gold.
Okay.
A real asset.
Real asset regime.
Yes, real asset regime.
I'm just aware of the fact that we're running out of time. You have this philosophy of running money. It's much more machine learning. You've created your own LLMs. Computational power has made a big difference the way you run money. So across which strategies, which funds are you using for this?
So we have 3 strategies currently running, all using the same methodology. However, as you go into multi-assets, of course, it opens more opportunities for you to use the machine's power in also not just selecting stocks, but also selecting asset classes and creating an optimal portfolio. So we have a long only SA equity fund. We have a balance fund. That's a Regulation 28 balance fund, and then we have a hedge fund. And obviously from the hedge fund, we can use the whole suite of the power of the machines, balance fund, and then the equity fund, which just does stock picking.
And so to remind me, you started your business in 2022, okay? Of those various strategies, you would have probably started them at different times. Of the longest running strategies, how's it performed relative to benchmarks?
So happy. It's been outperforming. All of them have been outperforming. All three. We launched the hedge fund and the multi-asset fund simultaneously in September 2023. And then the long only was launched a year later in September 2024. And obviously, there are cycles. We had a very good 2024, a not so good 2025, and then we started this year very strongly again. So, but overall, outperforming quite handsomely over this period.
So this has been an intriguing, you said you're doing really well in 2026. Okay. So we've had 2 months in 2026, the markets were flying, emerging markets, resources, back to your regime that you showed me a few seconds ago. Fast forward to March, markets all fall, particularly the stuff went up, fell the most. Now April, the things seem to be playing back again. How is the machine reacting to that much noise? Because it's not trending. If anything, it's doing completely the opposite. So how is the machine coped? You said it's doing well at the moment. Does it give you a different portfolio like weekly at the moment?
No, I think that's a power of it. It hasn't yet. I think because we use.
So in March, so the machine didn't react. So in March, you would have gone down with the markets then. What worked for you in January, February is what the machine was telling you to buy. But presumably in March, you had quite a big drawdown.
Yeah, so no, but just the combination. So we underperformed when the market was rallying, and then we outperformed. But underperformed but kept pace. And then when the market collapsed, we performed quite strongly relative to the market, and hence over the period.
Right, so you were more cautious in January and February in that period than March, because the machine was telling you that things were looking a little bit hairy, but not because they predicted the World War III. They were predicting valuations or other criteria. Is that right?
It just said that it actually said that defensiveness is being under.
So that was a criteria it picked up. The market wasn't pricing incorrectly.
Correct. It was saying that defensive characteristics of stocks were not appreciated by the market. It did, but once again, it didn't. It's not as though it underperformed massively in January. So it's a very well structured portfolio where it kept pace, underperforming by 1 or 0.5% in January, February, and then outperforming by 7% in the March when it went down.
Okay, so final question for me. You're a boutique fund manager, and it's a very competitive market out there. Are you underwritten by Mazi, and how does that work? Because it takes some time for companies to be profitable and stand on their own 2 feet, and you're a pretty young company. So tell me about Big Brother.
Yes, I mean, thank goodness for Big Brother. We try to do it on our own, but the South African environment makes it very, very difficult to launch our own business with all the back office and support staff that we require. So we realized that we needed a institutional backing to really give us time to build this. Mazi believed in it. They saw the value. And even they said, even if the funds for some reason takes a very long time to launch, they see value in our output that we share with them. But they just use a human overlay to decide whether they want to implement it. They're not quite as strict as in following the market. But even with that, they see value in that to continue this joint venture for as long as we are hopefully staying together.
Fantastic. Stephán, thanks for your time today. Thank you.
Thank you very much.